Hello and welcome back to All Things Money. My name's David Blain, and during today's show, we're recapping some of the numerous tax law changes that occurred in the year 2010 to help you prepare to save as much money as possible in this year when filling out your taxes, as well as in future years. If you have any comments or questions on the show, as always, please give us a call. Our number is 252-633-0107. Our email is allthingsmoney@dlblain.com, and our website is www.dlblain.com. And we'd love to hear from you, our listeners on 94.1 FM, WNBU, as well as Cable TV 10 in New Bern. So let's move on to the next section of tax breaks that were enacted or saved or reenacted in 2010. A lot of these are affecting individuals, so you may not have been subject to the estate tax, and if you don't earn over $200,000 or $250,000, the first two segments may not apply to you, but a lot of these will. So, first of all, certain temporary tax incentives expired at the end of 2009, and there is a ton of what they call temporary tax provisions in the code that I don't know why they keep doing this, but they're temporary and they extend them for 1 year or 2 years, and then they have to vote on them again to keep extending them. But they've been a part of the tax code for a number of years now, but what it does is it creates a lot of uncertainty for the IRS making the forms, the people that develop the software for tax preparation, as well as individuals. It really makes planning difficult because you don't know if these are going to be in effect or not. So on a sort of a side note, I really wish they would either make these permanent or just do away with them. So the 2010 Tax Relief Act extends most of these tax cuts, and we're going to go into them, retroactively for 2010 and 2011. So at the end of 2009, they expired. Congress didn't do anything. And so all year through 2010, if you were planning, you had to plan on the current law, which was that they were not going to be in effect. So at the end of December, they passed the law and said, oh, well, I think we'll extend them. And by the way, they go back to January. So anyway, the first one is the state and local sales tax deduction. And what that is if you get a deduction for state and local sales tax, you have the option of deducting state and local sales tax deduction. For example, if you don't have a high state sales tax that you pay, or you live in a state that doesn't have a state sales tax, it was a little bit unfair, so they allowed you to either submit for deduction sales tax numbers, or they have a chart that you can follow based on your income and things like that, a sort of standard sales tax deduction. So that's been extended. The teacher's classroom expense deduction, up to $250 of classroom supplies. And I come from, my wife's mother is a school teacher. My wife was a school teacher for a short amount of time. But we know a lot of teachers. And this $250 deduction is actually quite a joke. Most school teachers spend a ton of money in the classroom. I really wish they would raise that somehow. Anyway, the third point, and this is a really neat point that was extended. The tax-free distribution from IRAs for charities was extended. And what this does is, as you may or may not know, when you turn 70 and a half, if you have money in an IRA or a SEP IRA, now not a Roth, but a regular IRA, you must start taking money out and you must pay tax on it. So, in effect, what you had to do was, whether you wanted it or not, you had to take it out. Now then you could turn around and contribute to charity, and it would in effect have this, the same net deduction. But this provision in the tax code allows you to make a contribution directly from your IRA to a charity up to $100,000 per year. And it satisfies your minimum distribution requirements. So this is really a good thing for people. For example, let's say your itemized deductions were being phased out. You couldn't take them all, or maybe you don't even have enough to itemize. So if you took that IRA withdrawal, paid tax on it and then gave it to charity, you may not get the deduction for giving to charity or even the full amount. So what this allows people to do is transfer directly from their IRA to a charity, and it doesn't count as income, up to $100,000 a year. The other people that we find a great benefit for this, and a lot of our clients, is if they don't need the money in their IRA. They saved and they have other money or a pension, and they just don't need it. IRAs are not the greatest thing to pass on to an heir who isn't your spouse. There's some peculiarities in the tax code that we don't like. So a lot of people would just rather get rid of it. And so this allows them to give away $100,000, up to $100,000 each year, tax-free to a charity. It's a great provision in the code for higher income people. The American Opportunity Tax Credit, which is in the educational arena, expanded the Hope Education Credit and renamed the credit the American Opportunity Tax Credit. These education tax credits, you really have to stay on top of them because a lot of them are the exact same tax credit. They just change the name of them from year to year, just to confuse, I think, people like me in the industry as to what exactly they're talking about. But anyway, so qualified taxpayers will continue to be eligible for the credit based on 100% of the first $2,000 of tuition, fees, and materials, plus 25% of the next $2,000. And this is available to singles making less than $80,000 or married making less than $160,000. We'll get into education in a little bit. It's not a lot. Any of you sending children to school, if you make any reasonable amount of money, you generally don't get this tax credit. The last thing I want to mention, we're running out of time on the show here today, is for self-employed individuals. As someone that earns self-employment income, this has been a bone of contention I've had. For the year 2010, self-employed taxpayers will get the full deduction, including self-employment income tax deduction for health care. If you're an employee and you get your health care paid for, that's tax-free. Income tax-free, Social Security, Medicare tax-free. If you're self-employed, you get a deduction for the premiums you pay, but not from Social Security and Medicare. So it was a little discrepancy in the code. And so this is great. For self-employed people, it sort of levels the playing field. Well, that's all the time we have for today. We'll continue with our tax law update next week. We hope you join us. For All Things Money, I'm David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Inner Banks Media.